always think it's amazing, but I
Yes.
do have a question for
Yes.
you.
Go ahead.
I don't know if I've heard you with this scenario before,
Hmm.
but it's just changing the terms of that mortgage. If it's an interest only mortgage that an investor has, I'm just wondering your approach to that
All right. First,
because it's all interest payments.
right.
So, how are we going to attack that principle?
Help me to understand what you understand about an interest only loan. Tell me what you think. How does it
Okay.
actually work?
So, my understanding is that if I'm borrowing, let's say it's $100,000 or $500,000, interest only after the terms, if it's for 5 years, you still owe the same 500,000 unless you've been intentionally putting some monies towards the principal.
Okay. So you know you can put money towards principal.
Yes, I do.
Okay. So some people who get these interest only loans, even seasoned investors, and if it's an interest only period for 5 years, some of them use up the whole 5 years. An interest only loan will help you to increase your cash flow. All right. In this case, the interest only payment on this loan is $2,041.67 a month. And that doesn't change because we're not putting a dime towards principal. So it gives us an additional $286.89 worth of cash flow that we don't have to give to the bank. Okay. Because nothing's going to principal. So what if we did that for 5 years? Okay. What if we did that for 5 years? So that's 60 months. So we're going to bring our calculator up and we got $2,041.67. That's our mortgage payment because it's an interest only loan times 60. All right. 60 months. That's 5 years. That's $122,500. Now, what makes that palatable is if we were cash flowing and made a lot more money than that. Okay. Then just subtract the $122,000 that you paid from the money that you received on this loan, and then you keep the difference. All right. Is that how you understand having that interest only period for 5 years, Karan?
Yes, it is.
All right.
Yes.
Now, I need you all to write this down if you're taking notes. Control the principal payments and you control the loan. Control the principal payments and you control the loan. Watch this. Right now, I have tiny principal payments if this is a regular PI mortgage, principal and interest mortgage. I'm paying both principal and interest, but I have small principal payments, which helps me to take advantage at these higher interest rates of this loan. I can make more money on the back end by creating equity faster and cheaper. All right. But if I have an interest only loan where I'm paying $2,041.67 a month, Karan, what if I decided to take some money out of reserve and apply it to principal? Now, if I have this loan where I'm paying $286 in principal each month, am I in complete control of the principal payment, or is the bank telling me how much principal to pay? Karan?
You're in complete control of that principal payment because the bank is only expecting their interest.
Right. But if it's a principal and interest payment, I am
Okay.
not in complete control, am I?
No.
But if I have a interest only payment, I am in, like you said, I'm in complete control of principal payment.
Correct.
So folks, listen to this. Control the principal payment and you control the loan. Here's the second thing you need to understand. Interest payments I skip don't matter. Oops. Interest payments I skip don't matter. So if you have a loan, and I'm going to duplicate this tab, all right? Now, my interest payment now is $2,041, and I have interest only loan. And I did the same deal. I took $3,555.36. I borrowed it from myself, all right, and advanced it to this loan, all right? I would be paid down to $346,444.64 on the principal balance, okay? Now, folks, your interest only payment is based on the fact that you owe $350,000. This payment here, This $2,041.67 is based on owing $350,000. But what if, Karan, what if I owe less than $350,000? What will that do to my interest-only payment?
If you owe less than the 300,000, it's going to be less interest that you're paying
What?
because you're paying it on less money.
Are you telling me not only am I in complete control of when I pay principal, I'm in complete control of my monthly payment now. I can bring it down whenever I want. Let's take a look at that. I'm going to take this $346,444.64 because I'm going to prepay the $35.55.36. I'm going to save about $24,000 in interest out of all of that money that I said I was going to be able to pay over the next 5 years. I'm going to pay, if I keep that interest only for 5 years, I'm going to pay out $122,500. By advancing $3,500 of that money to the loan that I would have paid out, I just reduced the amount of interest, all right, by $24,000. So now the amount of money that I'm going to pay out in interest is under $100,000 just by that one move. I could take $3,500 out of my savings account, advance it to this loan, and kill over $24,000 in interest I don't have to pay. And watch this. I'm going to take this $346,000. We're going to copy that. We're going to put it into this loan. All right. This is how much we owe now. Okay. All right. We want to try to get it to paste. All right. There we go. Paste. All right. We got to take that comma out. It's still at 7%, right? All right. And we're going to keep it at that same amortization. Okay. Look at this. Look at this. Look at this. Watch this. Here's my new payment, $2,304.90. My old payment was $23.28. My new payment is now $23.04. So I can actually control what my payment is. So I actually have my payment is $23.04.90. $23.04.90. So if I continue to put money on principal, Karan, I'm going to be able to save a ton of interest and control what my payment is going to be. My payment is going to be less and less and less because I'm applying money to principal, and I'm saving a ton of interest every time I put money towards that principal. How does that sound to you?
Don, absolutely amazing.
Okay. So folks, keep this in mind. Keep this in mind. If you have an interest-only payment, make the best of it. Know when to put money on principal and then when not to. Now, when we use our cash reserves, to put money on principal, then we need to take a look at how to build the reserves back up, okay, to where they were. So if we take money out, then what happens is we don't continually take money out of that reserves. We take the money out, we get the benefit, and then we just make our minimum payments until we build up our reserves to where they were before. Then once we build it up, we can then make another payment, taking money from our reserves and applying it to principal. Build it up and do it again. Build it up and do it again. We can save thousands, hundreds of thousands of dollars in interest we don't have to pay. And Karan, it's even more astounding than that.
Don, numbers just got to make sense. And I've got to say, that's what I just love about your program, because your numbers are always on point. They always make sense. It helps you to think about what you're doing with what you are doing and how you tackle your mortgage or any debt. But I love it.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.